Venture capitalists play a pivotal role in nurturing startups, providing not only capital but also strategic guidance to foster growth and innovation. However, given the high-risk nature of early-stage investments, VCs are meticulous in their selection process, evaluating potential investments through a multifaceted lens. Understanding the key criteria VCs prioritize can offer invaluable insights for entrepreneurs seeking funding. When it comes to venture capital investment decisions, the leadership team of a startup is often regarded as the single most crucial factor. More than the idea itself or even the size of the market, it is the quality of the people at the helms that largely determines a company's potential for success. VCs seek out founding teams who demonstrate a rare combination of passion, expertise, and resilience, qualities essential for navigating the often turbulent journey of building a high-growth company. Experience and expertise stand out as key indicators. Founders who bring a proven track record in their industry or relevant fields inspire a strong sense of confidence among investors. Their deep knowledge of the competitive landscape, customer needs, and potential pitfalls provides a solid foundation on which to build and scale a venture. Adaptability and coachability are equally prized traits. The path from startup to successful company is seldom straightforward. Unexpected challenges and shifts in the market are inevitable. VCs look for leaders who not only welcome feedback, but also demonstrate the flexibility to pivot their strategies when necessary. An ability to learn, adjust, and stay agile often marks the difference between startups that thrive and those that falter. Finally, commitment and tenacity are non-negotiable. Building a startup demands extraordinary levels of dedication and resilience. VCs closely assess the founder's level of commitment, how deeply they are invested in their vision, and how prepared they are to persevere through setbacks, competition, and the inevitable periods of doubt. Ultimately, while market opportunities and product innovation are critical, it is the strength, character, and capability of the leadership team that most often convinces venture capitalists to invest. In their pursuit of substantial returns, VC investors focus heavily on identifying startups operating within markets that offer significant growth potential. A promising market opportunity is essential for generating returns that can meaningfully impact the overall performance of a fund. To evaluate this, VCs closely examine several factors. First, they consider the total addressable market, or TAM. A large and expanding TAM signals that there is ample opportunity for a startup to capture significant value over time. Without a sufficiently broad market, even the most innovative solutions may struggle to scale effectively. In addition, VCs assess current market trends. Alignment with favorable industry movements, such as technological advancements, demographic shifts, or regulatory changes, can dramatically enhance a startup's prospects, giving it momentum as it grows. Finally, the competitive landscape is analyzed in depth. VCs look at existing players in the market and evaluate whether the startup has the potential to establish a defensible position. The ability to stand out in a crowded space, whether through superior technology, customer experience, or strategic advantages, is often a key determinant of investment readiness. A startup's business model plays a crucial role in attracting venture capital. Beyond simply addressing a clear problem, the company must offer a solution that is innovative and highly scalable. VCs seek startups with a unique value proposition, solutions that introduce a new, and often disruptive, approach to the market. Products or services that provide distinct advantages over existing alternatives are far more likely to capture attention. It is this innovation edge that sets successful startups apart. Most businesses can raise capital through traditional means like loans or private equity, but without a meaningful innovation advantage, they typically fail to spark interest from VC investors. Scalability is another major criterion. A compelling business model must allow for rapid growth without requiring expenses to rise proportionally, enabling the startup to expand efficiently. Lastly, clear and diversified revenue streams are a strong positive indicator. Demonstrating multiple avenues for generating income signals that the business has long-term potential for profitability and resilience against market fluctuations. Demonstrated traction is critical for VCs when evaluating a startup's viability. Early signs of success help de-risk the investment and provide evidence that the product or service resonates with the market. Customer adoption is often one of the strongest indicators. Startups that can show early customer acquisition and high retention rates demonstrate that there is real demand for their offering. Strategic partnerships are also highly valued. Collaborations with established organizations can validate a startup's value proposition, provide access to broader markets, and bolster credibility in the eyes of future customers and investors. Moreover, achieving product development milestones is another important measure. When a team consistently meets its goals and advances its roadmap, it reflects both strong execution capabilities and a disciplined approach to growth. Even if a startup has yet to achieve profitability, VCs scrutinize financial forecasts to better understand potential returns. A well-articulated financial plan can offer critical insights into the startup's growth trajectory and operational discipline. VCs look first at revenue growth projections. These projections must strike a balance between ambition and realism. Overly optimistic forecasts can undermine credibility, while conservative projections may signal a lack of vision. Burn rate and runway are equally important considerations. VCs want to understand how quickly a startup is spending its capital and how much time it has before requiring additional funding. Strong financial stewardship at an early stage can be a decisive advantage. Additionally, VCs dive deep into unit economics. Metrics like customer acquisition cost, or CAC, and lifetime value, or LTV, provide valuable indicators of the business's underlying sustainability and future profitability. Venture capital investments are made with a clear eye toward eventual exits, which are necessary for realizing returns. Accordingly, assessing exit potential is a fundamental part of the investment process. VCs consider a startup's acquisition appeal. The startup must possess assets, such as proprietary technology, strong market positions, or brand loyalty that could attract potential acquirers seeking strategic advantages. Another path to liquidity is the possibility of an initial public offering, abbreviated IPO. While rarer, an IPO can offer substantial returns and long-term growth opportunities for investors and founders alike. Additionally, existing strategic partnerships can pave the way for exit opportunities. Alliances with larger corporations may evolve into acquisition discussions, offering another route to successful outcomes for both the startup and its investors. No venture capital investment is without risk. Recognizing this, VCs undertake rigorous due diligence to assess the full spectrum of potential challenges a startup might face. They begin by examining market risks, which can include factors like market volatility, shifting consumer preferences, or sudden regulatory changes that could impact growth prospects. Operational risks are another major area of focus. These include challenges associated with scaling operations, potential weaknesses in the supply chain, technological hurdles, and gaps in execution capability. Finally, VCs analyze financial risks, including concerns about cash flow management, the likelihood of future funding needs, and broader economic conditions that could constrain growth. By meticulously evaluating these dimensions, VCs seek to identify startups that not only promise innovation, but also possess the foundational strength to navigate uncertainties and achieve sustainable growth. For entrepreneurs, understanding and addressing these concerns can significantly enhance their appeal to potential investors.